Good afternoon. Welcome to the 2019 Defined Benefit Plans Trend Survey. Thank you very much for joining us today. All listeners are going to be in a listen-only mode during the entire webinar. If you do want to ask a question, please use the Q&A function on the lower right-hand side of your screen. We are recording the webinar, and the copy of the presentation will be available, so they will both be located on our website at www.nepc.com. My name is Brad Smith. I'm a member of the corporate pension team at NEPC. Joining me today are Kelly Regan, who is a senior consultant on the corporate pension team, and Kevin Novak, who's a consultant on our healthcare team. NEPC continues to grow. We're very proud of the fact we've got nearly 300 employees across 8 regional offices. We actually pretty much have the U.S. entirely covered today. Kevin's in from California. I work out of the Atlanta office, and Kelly works up here in Boston. One of the things that we're really proud of is that we know that Manager Alpha does not grow on trees. So we do have a 52 dedicated member manager research team across public markets, hedge funds, private markets, and real assets. One of the hallmarks of NEPC is we really do seek to provide custom solutions for our clients. If you look at the lower right-hand portion of the slide, you'll notice that we have 7 different practice groups. And I think if you compare us to the competition out there, we service one of the most diverse client books out there. And the reason that's really helpful or important to corporate or healthcare organizations is the fact that our public fund clients, our very large public fund clients, continue to be very active in the public equity or the private markets, as well as real estate funds. Our endowment and foundation clients are incredibly active in the hedge fund space. So we're able to get incredible access for our clients in both the corporate and healthcare fields, primarily leveraging the work we're doing in these other markets. As a privately held partnership, we also have one of the most stable consulting teams in the industry, and we're really proud of the fact we just added 3 new partners this year to take us up to 44 partners. So for the agenda today, what I'm going to do is I'm going to start out giving a brief update on the markets and comparing 2017 to 2019, because 2017 was the last time we did this trend survey. Then I'm going to turn it over to Kelly and Kevin to take you through the results of the survey. And again, we'll answer any questions you may have at the end of the webinar. You can ask questions at any time, but let's kind of get started. So some of the good news, funded ratios have actually improved since the last survey. If you look at the survey, only 46% of sponsors indicated they had a funded status above 90%. In 2019, that was up to 58%. We think that that data is a little misleading because we believe that a lot of the funded status improvements occurred during 2018 with rising discount rates, as well as we saw a number of plan sponsors making elective contributions to try to minimize the PBGC variable rate premium. The other thing that's interesting to note is that 62% of plans in the survey today still have some form of benefit accrual occurring. So keep that in mind when we start looking at the types of asset classes that are being utilized, as well as the overall level of LDI. In general, what you'll find is that plans that are open and closed but not frozen tend to have slightly higher allocations to return-seeking assets. Finally, when we looked at market sentiment, what was interesting this year is 84% of respondents indicated that they believed a recession was likely to occur within the next 3 years. The other interesting thing is that when we did the survey back in 2017, close to 60% of sponsors expected rates to go higher. That was only 16% in 2019. The other thing that was interesting is that this year, close to 60% of respondents also were bearish on the overall markets. So let's take a look at what happened since 2017. So going back to 2017 through the end of 2019, the Standard & Poor's 500 is up 26%. Developed market equities measured by the EFA are up 5%, and emerging markets are up 1%. Now, we issued the survey back in September of 2019, so it's not surprising that a lot of plan sponsors were bearish on the markets when you can see what happened in mid-2019. The interesting thing is that the S&P 500 is actually up 11% since we issued the survey. When we look at what happened with credits and Treasury yields, this is where we think that some of the data gets lost by us having a 2-year time period between the surveys. So if you look at what happened at the end of 2017 through the end of 2018, you can see that AA credits actually, the yield actually increased by about 71 basis points during the year. Spreads widened by 41 basis points. Roll forward to the end of 2019, you can see that both treasuries and spreads came in. Spreads were only 92 basis points at the end of 2019. If you look at the what's happened to markets since we issued the survey, again, a lot of plan sponsors were bearish on markets. The S&P 500 was up 11%. They also did not expect rates to rise. And interestingly enough, since the survey was issued, both have occurred. Equity markets have gone up, and rates have gone up modestly since the end of the year. So what's overall market sentiment? So here we can see that there's actually a bit of a bifurcation here between corporate and healthcare. If you look at the equity bearish, bullish, more corporate plan sponsors were bearish than healthcare. Healthcare was still more of a coin toss. When you look at the recession, the healthcare clients were actually also a little bit more optimistic there. So 60% of respondents expected a recession in the next 18 months to 3 years, whereas 59% of corporate plan sponsors expected a recession to occur within the next 18 months. So again, that was just really interesting here. So this is an exhibit that's showing you the change in funded status. The source here is the Milliman 100 Pension Fund Index that's released on a monthly basis. And what you'll notice here is that the funded status of the typical plan actually improved between 2017 to 2018, 87.6% up to 89.4%. You can see that the discount rate rose from about 353 to 419. You roll forward to the end of 2019. When we did the survey itself back in September, the funded status was a little bit lower. Funded status improved by about 2 percentage points in December, but you can see if you look at the funded status from 2017 through 2019, the funded status has improved modestly over time. So what I'd like to do now is turn it over to Kelly, and she'll get us started here with the survey results for 2019.
Thanks, Brad, and thank you everyone for joining us today and for those who participated in our survey. We are very excited to release the results of NEPC's 2019 Defined Benefit Trends Survey. Before we turn to the results, I wanted to provide some background on the composition of the survey. This year was NEPC's 8th survey, and we had 121 defined benefit plan sponsors participate, which is a very healthy number. The defined benefit landscape is a key topic for plan sponsors, consultants, and investment managers, so we are very pleased with the response rate. This sample size contained $145 billion in assets, with a similar breakout between large plans and small plans, as shown by the top right chart, which is consistent with previous years. The universe was also diversely distributed amongst organizational types. The majority of respondents were corporate plans, but consistent with our past surveys, 29% of participants were healthcare sponsors, as they continue to be focused on this area. As we look through to the responses, the survey also had a diverse range of plans with different benefit formulas, such as final average pay, career average pay, and cash balance plans. We think that the results of the survey captures the developments in the industry, given the diversification of plan size and organizational types, as well as the amount of assets that are included in the survey. Additionally, when compiling the results, we compare them to what we see across NEPC's client base to determine if they are reasonable, which we think they are. It is important to note that of the respondents, roughly 30% were NEPC clients. So we are confident the survey results represent the trends of the overall industry. I will turn to the actual results and begin with plan status. We haven't seen much change with the percentage of plans that are open, closed, or frozen from 2017, shown in the dark blue bars, versus 2019 in the light blue bars. The results over the past years have really been divided amongst a third to each of these areas. We continue to see that a majority of plans are still accruing future benefits at 62%, with no change since 2017. While in the past, we haven't expected many changes in the future to plan status, that is a little different in the 2019 survey. This year, when we asked those plans that are open today if they plan on remaining open in the foreseeable future, we did see a decline. In 2017, 80% said they will continue to offer an active defined benefit plan in the future, as they believe their plans attract employee talent, or that the plan's funded status risks are being managed. This year, that number decreased to 63%, which indicates to us that the percentage of open plans is likely to decline in the future. This year, we looked at several underlying characteristics of open, closed, and frozen plans. What we found was not that surprising to us. Plans that are open tend to utilize LDI less and have higher EROAs as a result of lower fixed income allocations. As expected, frozen plans have the highest adoption of LDI and glide paths, resulting in lower EROAs given current yields on fixed income investments. Frozen plans have the lowest funded ratios of the group, with almost half above 90%, and open plans appear to be better funded at 69%, as 69% have a funded status over 90%. This is not unexpected, as organizations with open plans tend to have financial flexibility, resulting in a better funded position. I didn't mention closed plans, but they fit right in the middle of open and frozen plans across most metrics. One new area of the survey is a highlight on cash balance plans. A majority of respondents have traditional final average pay, career average pay, or a hybrid plan at 74% of the universe. These more traditional plans tend to be higher adopters of LDI, with 85% indicating they use LDI. However, we note that 27% of these plans have a portion of their liability that is cash balance. For these plan sponsors, we encourage you to review the plan's liability and see what percentage of the liability is cash balance. Depending on the size, the cash balance portion can reduce the overall duration of the liability and impact the LDI hedging program. We have seen a growing number of cash balance plans, as the design can be attractive due to their DC-like features, such as the account balance formula. However, only 21% of survey participants stated that they have plans that are fully cash balanced. 91% of these plans have selected either a treasury yield or a combination method for their plan's crediting rate. What was surprising to us is that over half of the pure cash balance plans utilize LDI, and 82% had over 50% of their portfolios allocated to LDI. Cash balance plans operate differently than traditional DB plans and can present a distinct challenge when trying to hedge liabilities. We suggest that sponsors who are utilizing LDI and cash balance plans assess the implications of their plan's unique characteristics on the asset allocation strategy. We continue to see plan sponsors reduce their rate of return assumptions. This year, we saw a 14% increase in plans with a rate of return equal or less than 6%, as illustrated by the left hand of the chart. Of these plans, 81% use LDI and 60% are frozen. We expect that this is also a result of the market environment as bond yields remain low. As you can see, the increase in the 6% or less area corresponds to the decrease in plan sponsors with a return of 7.5% or more. Not surprising to us, these plans tend to have a lower utilization of LDI, as only 42% indicated they use LDI, and 76% are still accruing future benefits. These open and closed plans may have higher equity and alternative allocations, which may help support higher long-term returns. This decline of return expectations is consistent with NEPC's 2020 return assumptions, as the recent strong equity market has borrowed from future returns, and we continue to see a downward pressure on discount rates. Brad mentioned in the market review, funded ratios increased in 2018 based on the data in the marketplace, but remained relatively flat in 2019. We issued this survey in September 2019, and the respondent universe at that time indicated a significant increase in funded status. In 2017, there were 46% of plans that had a funded status above 90%, as shown by the right-hand side of this chart. This year, that number increased by 12% to a total of 58% of plans with a funded status above 90%. This was one of the biggest trends we witnessed in the survey this year. One caveat is that some of the reported funded statuses may be as of 2018 year end, which was a year of significant contributions and higher discount rates. Now I will transition to provide our findings on LDI and glide path utilization. LDI continues to be a big topic across corporate and healthcare defined benefit plan sponsors, and while it may not be appropriate for all plans given unique goals and objectives, we continue to be interested in the views of plan sponsors regarding this topic. We asked plan sponsors if they currently use LDI, and the majority said yes, as shown by the 69% allocation on the right-hand side of this chart. This reflects a 13% increase since 2017. This trend has been consistent in that a majority of respondents have used LDI since we issued the survey in 2011. When we look under the hood, we also note that LDI usage is increasing across both healthcare and corporate plans. In 2019, 69% of corporate plans had an allocation to LDI compared to 59% in 2017, reflecting a 10% increase. Healthcare plan sponsors have embraced LDI more than their corporate counterparts, as 75% of these plans had an allocation to LDI compared to 56% in 2017. When we assess future adoption of LDI, we note that this year, 8% of respondents indicated they were considering LDI now, which is down from 15% in 2017. This decrease is not surprising to us given the low interest rate environment. LDI is not appropriate for everyone, as shown by the 30% here of plans that are not using LDI today. When we ask these plan sponsors for the reasons why they are not implementing LDI, interest rate levels and plan status were the two most cited reasons. At NEPC, we certainly see a number of clients who continue to utilize a total return approach. For those plan sponsors that employ LDI, we asked, what is your allocation to LDI? 44% of respondents had an allocation of 51% or more to LDI, which represents a 35% increase since the start of the survey in 2011, as shown on the right-hand side of this chart. We continue to see plan sponsors use LDI, and a number of them have increased their allocations and interest rate hedge ratios over time. The initial observation regarding glide path that we want to share with you is that glide path utilization increased in the 2019 survey for a total pool of respondents. Those plan sponsors utilizing glide path went from 46% in 2017 to 52% in 2019. To provide you with some longer-term context, in our first survey conducted in 2011, only 27% of respondents indicated they used a glide path. This is a significant increase in 8 years as utilization almost doubled. We also looked at the glide path results by plan types. The increase over 2 years was similar across both corporate and healthcare organizations. However, when we looked deeper, 70% of healthcare organizations have a glide path in place, which differs pretty dramatically from their corporate counterparts, as only 47% have a glide path in place today. Of those that do not have a glide path, 24% say they will implement in the future. One characteristic that we found interesting is that those plan sponsors that have no plans to implement a glide path, 62% of them had a funded status greater than 90%. One of the new questions we asked this year was regarding glide path triggers. A majority of plan sponsors utilize a changing funded status as their key metric. However, 20% incorporate interest rates and 15% use a time-based approach. What was interesting is that 14% of respondents utilized all three metrics and 18% used either time or interest rates along with funded status. While time and interest rates are not used by the majority, they certainly are being considered. Along with the increase in the use of glide paths, we also continue to see that plan sponsors remain active in terms of formally reviewing their glide paths. We observed an increase over the 2 years for those that completed a glide path review in the last 12 months. 78% said they conducted a review at some point over the prior year versus 70% 2 years ago. However, that level of review has resulted in very little activity in sponsors making changes to the established glide path. We asked participants if the review resulted in any changes to their glide path. 71% maintained their current glide path compared to 53% 2 years ago. Additionally, we saw a decrease in plan sponsors that re-risked their glide path, as 8% indicated they have taken on additional risk in their portfolios in 2019, which is a decline from 12% 2 years ago. So we didn't see many plan sponsors making changes to the glide path, but what about moving along the glide path in 2019 and hitting the triggers that have been established? In our 2019 results, we saw a notable decrease by almost half in those that hit a trigger in 2019 versus 2017. One of the interesting things from this data point is that while we saw an increase in funded ratios, we do not believe this occurred in 2019 as triggers were not hit. It is more likely that funded ratios increased in 2018 as discount rates moved higher and additional contributions occurred. One final comment that I will make before closing out on glide paths is that for the 18% of plans that hit a trigger in 2019, 78% took action, with a third of them saying it was due to a passage of time and not market movements. For the 22% that deferred taking action, 100% of those responses stated it was due to their view of the interest rate environment which caused them to pause. I will now turn it over to Kevin to provide an overview of liability reduction strategies, asset allocations of the respondents, as well as alternatives and other return-seeking strategies.
Thanks, Kelly. So I'll begin with our observations on the use of de-risking strategies and then transition to our findings related to asset allocation. Now, there's a handful of common de-risking strategies that we've observed plan sponsors engaging in to attempt to lower the risk associated with managing their pension plans. And within the next few slides, we've illustrated how these strategies have been utilized and how our most recent results compare to the prior year. But what I think you'll notice at a high level is that plan sponsors have been slightly more active in reducing their pension liabilities, whether that means they've already implemented or are actively planning to implement these strategies. So on page 26, we have probably the most common form of de-risking strategy utilized in the marketplace, and that is lump sums. So in the top bar, you see that 70% of respondents indicated that they have implemented lump sums, which is a 6% increase from our last survey in 2017. There's also an additional 10% planning lump sums at the moment, but that's actually a slight decrease from those that were planning back in 2017. And we noted on the page that 2/3 of those planning lump sums this year will issue the option of retirees. Now, with most plan sponsors having either implemented or planning lump sums, there are still about 20% that either haven't considered or considered but rejected the idea, which may be influenced by concerns regarding PBGC premiums. And we found that about half of those plans are actually still open, and 42% have a funded status level below 89%. Now, another popular liability reduction strategy is the annuity buyout, which we have detail on page 27. Similar to what we observed with lump sums, we did see a slight increase in plan sponsors that have implemented annuity buyouts. And in 2019, that number is approaching 20% versus only about 13% 2 years ago. With that said, there's still over 40% of plan sponsors that haven't considered annuity buyouts at this point. On page 28, we have terminations where, again, we saw a slight increase from 2017 for plans that have already implemented plan terminations. But I think the key point here is that we did observe 15% of respondents indicating that they were planning a termination, but the timing of that certainly varies. Interestingly, over half, actually 57%, expected their termination to take at least 5 years to execute, but only 14% expect to complete their planned termination within the next year. And then on page 29, we have plan hibernation. And for those unaware of what a hibernation strategy does, it looks to minimize surplus risk by very closely matching assets with liabilities. And this year, we observed a notable increase in plan sponsors that are either planning or have already implemented a hibernation strategy. And for planning, that number is 12%, and for those who have implemented, it's 8%. Now, while the absolute number of those who've embraced hibernation is low relative to, say, lump sums or annuity buyouts, hibernation strategies have doubled over the past 2 years and actually increased by 4 times over the past 4 years. And perhaps not too surprising, the profile of these plans tends to be better funded, with heavy use of LDI, and most, actually 4 out of 5, are either closed or frozen. Now, one additional approach to reducing liabilities and closing the unfunded gap is the notion of issuing debt as a means to make additional contributions to improve funded status. And I think the key takeaway here is that this action isn't necessarily top of mind with most plan sponsors, as we noted that 2/3 still have not even considered issuing debt to improve funded status. With that said, we did see a noticeable difference between corporate and healthcare sponsors here, the latter being more inclined to issue debt specifically for this purpose. And we've called out 16% of healthcare versus only 12% on the corporate side. Now, let's switch gears and discuss our observations on asset allocation. So Kelly covered a few of these data points earlier today, but we've put things into the context of plan asset allocation across equity, LDI, other fixed income, and alternatives. And so, I think this table is helpful for some perspective on how various characteristics impact a plan's investment structure. So just a couple of the key takeaways here are first, in general, plans remain fairly diversified across these broad asset class buckets, with 36% in equities, 52% allocated to fixed income, and still 12% in alternatives. Second, Kelly indicated earlier that frozen plans have much lower return expectations than their open and closed counterparts. And I think this is consistent with our findings from an asset allocation standpoint, where we found that frozen portfolios simply have much less in equity and alternatives and more in fixed income assets. And of course, there's a trade-off there with more fixed income leading to overall lower return expectations. And from our perspective, that's neither good nor bad, given the fact that, in general, choosing to hold a heavy allocation in LDI means your focus is generally more on managing your funded status volatility as opposed to focusing on strictly investment returns. And then the last point here I'll touch on relates to the use of alternatives, which, as you can see on page 32, takes up 12% of pension assets on average. And we've actually broken this component out a bit more on page 33. Now, while we've observed fewer plans utilizing alternatives versus 2 years ago, these investments are still prevalent among pension plans today, with 2/3 allocating to areas like hedge funds, private equity, and real assets. And what's more is that 42% of respondents maintain an allocation to alternatives of 11% or more of total plan assets. And as we've called out at the top of page 33, there's pretty broad representation within the specific types of alternatives. But hedge funds, as you can tell, are the most utilized at 40%. So we've talked a lot about risk reduction strategies, whether that be through actions like lump sums or annuity buyouts, or even more specific to investments with LDI and the use of glide paths. But we've also seen interest in what we'll call return-seeking risk reduction strategies. And based on our findings this year, there has been some appetite for things like tail risk hedging and factor-based equity, but we've observed some pretty meaningful dollars allocated to defensive equity strategies, with 22% of respondents indicating that they've already implemented that approach. Now, given where we're at in the economic cycle and general uncertainty in capital markets, we're going to keep an eye out for further use of these types of strategies from plan sponsors. Now, another interesting investment approach we've been tracking relates to ESG, or environmental, social, and governance strategies. And so we conducted a flash poll of plan sponsors in 2018 and asked if they've incorporated ESG factors into their investment choices. And at that time, we saw that 6% actually were incorporating these types of strategies. Now, fast forward 1 year to our trend survey, we saw an uptick to 11% of plan sponsors incorporating ESG factors. And I think that's consistent with discussions that we're having with our clients over the past few years on the topic. With that said, we were a little surprised here at the decrease year over year of plan sponsors indicating that they may be interested in ESG in the future. Now, for those of you that are interested in learning more about ESG or how you might begin to incorporate ESG factors into your investment process, we at NEPC have a dedicated impact investing group that has extensive experience both educating as well as assisting plan sponsors on the topic. Now, I'll wrap up with some perspective on how plan sponsors are managing their investments. And one topic that we keep hearing from our clients and really from the industry more broadly is the interest in OCIO or discretionary services, where a consultant would generally take over the fiduciary responsibility of selecting investment managers and assuming back office obligations like directing trades and reviewing subscription documents. And we've actually seen an increase in plan sponsors that have gone the OCIO route, with 20% indicating that they have outsourced the management of their investment portfolio to a third party like NEPC. And when asked to rank what the primary factors were in opting for an OCIO model, the two most cited reasons were improving performance and improving fiduciary oversight. And those are two big benefits of an OCIO model. But in our experience, there's also generally a noticeable reduction in the administrative burden of outsourcing your investment portfolio. And in reality, there are oftentimes fee savings related to investment manager fees that can be material to a plan sponsor. So that's an overview of our findings from this year's survey. At this point, I'll turn it back over to Brad to wrap up.
Just as a reminder, you can submit a question using the Q&A function. We did receive a couple of questions. Also, just a little bit of housekeeping. Below are the contacts for the presenters today. So if you'd rather reach out to somebody directly, those are the email addresses you can reach all of us at. And more importantly, just if you need any other follow-up, just let us know. So, Kelly?
So one of the questions we received during the webinar, and Kevin, I'll direct this to you, is what from the healthcare results surprised you the most?
So, I think from a healthcare perspective, I think the magnitude of the increase in the use of LDI was a bit surprising. And Kelly mentioned it earlier that these numbers were, 56% back in 2017 versus 75% just 2 years later in 2019. So that was a bit surprising, but really after kind of digging into the information and looking at the increase in funded status from 2 years ago, I think it does make sense to us given the fact that typically higher funding levels lead to higher usage of LDI.
I'm just going to jump in here and answer it also from a total survey respondent perspective. I'm always interested in what plan sponsors are thinking. I was really surprised to see the number of bearish responses from plan sponsors. Again, it's not a survey metric on LDI, but it just points to the fact that the direction of market sentiment tends to lead to groupthink. We did have some softening in the equity markets, and the Fed was aggressively cutting rates, and institutional investors were thinking that a recession was imminent. We did have a couple of days where the yield curve did invert, but since that time, equity markets are up 11%. Rates are up actually modestly by 20 basis points, which really just highlights the importance of building a diversified portfolio. I think at NEPC, we really do try to make sure we build all-weather portfolios that stand the test of time regardless of the direction of rates or equity markets. So there was a question on the data itself, and Kelly, I'll let you answer this. Have you analyzed whether by definition the folks responding to the survey have higher funded rates?
So we receive all the data, and we don't really know who is responding, so we can't tie it to if these are actual increases. So we're just relying on the data and haven't really analyzed the results if they're true per organization. Another question came in on a copy of the presentation. Again, we will post the webinar recording to our website, and we'll also post the full presentation to our website, which you can all download.
So just go to www.nepc.com, and you'll click on the link to the webinars. So thank you all again very much for your time today. We really appreciate your interest. And again, if you have any questions on any of the data, please feel free to reach out to any of us here. Thank you again.